Here we go. I think. Yeah. I gotta think about the intro real quick. I'm like out of practice here. All right. Welcome back to the Financial Illiterates. That's a financial as you would find in the dictionary, and illiterates, Illiterates.
Nailed it.
My name is Trey, and this is Justin. I nailed it. Yeah, I know. I'm still like a little bit rusty coming back from the long break. I nailed the illiterates part, and then I'm like, I don't know where to go next.
It's like we're starting over again.
Yeah. So today we wanted to do like a quick little reaction video. It's not going to be one of those like clickbaity, we disagree with everything reaction videos. It's probably going to be more like you should just watch the video because we agree with everything reaction things.
And that's our podcast.
Anyways, we're going to do it.
That's the entire podcast. Yep. We're done.
Yep. Done. So just hit us up if you have any comments, questions. No, just kidding. So Graham Stephan posted a video. When was it? Last week, February 26th. Yeah, that was probably last week. The 5 financial goals to achieve in your 20s. And as I was watching it, it's a great video. The way I really heard it was the 5 financial goals to achieve by the time you're 30. And I thought this was an interesting one for us to cover because you are almost 30 and yep. I'm just barely past 30.
You are way over 30 and I will be 30.
Barely past 30.
Maybe 6 months I'll be 30. You are way past it though, I think. You're like, what, going to be?
Are you really only 6 months from 30?
Yeah, it's real now.
I'm doing a horrible job at planning this ridiculous party.
I'm looking forward to it, dude. I'm not going to peak until I'm like 40, 45. So I'm still like in that kind of awkward growth stage, I feel like.
Yeah. Anyways, so should we just go through it before we just end up talking about age the whole time?
Yeah. And for those unfamiliar, Graham Stephan is a very savvy real estate mogul in Southern California, but he also has a great personal finance YouTube channel that both Trey and I follow.
Mogul. Do you think he refers to himself as a real estate mogul?
I don't know. I had something on here about mogul and I wanted to work it into the show, and that was really the only spot. So Graham, if that's not what you refer to yourself as, I really apologize. I just wanted to add that.
Like he would just cringe with that term. He'd be like, "Oh, mogul."
I think I cringed when I said it.
He's like one of the least fancy real estate investors that exists.
And I think
calling him a real estate mogul.
I mean,
it's probably technically true. I don't even know what mogul means, really. I just know it means you're awesome. But
mogul is the word of the day. I worked it in. Sorry, Graham.
You did. I mean, it was good. It was good. But before we lose too many people listening to this or watching this or whatever you're doing, because maybe we got the video right this time and it will be released on YouTube. The first one that he puts in here is by the time you're 30, hit a credit score of a 750.
Yep. And I completely agree with that. And it's easy to do if you open accounts when you're young, because age of accounts really matters. And then for me, basically, I got to that range just by paying off my credit card every month and keeping my revolving utilization low.
And I did not. So I mean, I had some tight financial times over the past few years. And at the same time, I didn't really care a whole lot about my credit score because I was going to invest in multifamily real estate. And the credit score doesn't really matter there because it's not you that's insuring it. It's the property, basically. And so I did all those things that you said, but then I also let some things go to collections. And that has a pretty big impact. I'm right now probably sitting just shy of a 740, which is really all I need is a 740 to get the lowest interest rates on mortgages. So I'm not too far off, but like TransUnion reports my credit score way lower, like a 680, 690, something like that, because they take collections so heavily weighted into their score versus everyone else. And those collections take 7 years to go off, even if you've paid them off. So I've fully paid off all of my collection debts, and they're still going to take 7 years to get off my record. So don't do that. My lesson learned here is keep your options open, and care about that credit score. Don't care about getting an 800 though. I think 750 is a good goal because it gives you that buffer over 740, which is what you need for good rates. But you don't need an 800.
Yeah. Well, what was it like above, like 741 and above? Like that's the magic number because then you get really the best rates above 740.
Yep, anything over 740, you're getting the best rates. So 750, I think, is like a nice round number with a nice buffer above 740. But anything north of that, it just doesn't really matter.
Yep. And just so we have some numbers to put to it and like how the credit scores work, I was looking at this earlier where it's like missed payments is huge. It's like 35% of your credit score. So if you start missing payments, then
Yes,
that's
it
really going to
is.
hurt it. And then
Yep.
and then
I
revolving
missed
utilization.
I missed one payment on our Explorer way back when, and not by much, by like a week or something like that. It just went over the limit. And most places, if you miss a payment, like you have quite a grace period before they're reporting that to collections. Ford, that was not the case. You're like 7 days late, it's on your credit score.
Oh, shit.
And that had a big impact. I don't remember exactly the numbers, but it was more than a 10-point impact. It's now like worked its way off the credit score, but it was very impactful. So yeah, pay stuff on time, auto pay stuff, really.
Yeah, auto pay helps there. All right, want to jump into number 2?
Yes. What's number 2?
Get out of bad debt.
Oh, I loved this one. When
Yeah.
he said this, I was super excited because everyone is always talking about get rid of your debt, get rid of your debt, get rid of your debt. And I'm like, but what about the good debt? Like, I want more debt. I don't have enough debt right now, is my problem.
Yeah, there's good debt to be had.
Yeah. So I really liked that he clarified good debt and bad debt. And real quick, for anyone that's curious, my definition of good debt versus bad debt is good debt is things like home mortgages on investment properties that are going to appreciate or cash flow. Really, any sort of low interest rate debt that is going to make you more money because you have it. Bad debt is debt that's high interest rate and not going to make you more money. I paused because I thought of a better way to phrase that. It's basically good debt is debt where you're making more money from having it than you're paying an interest rate. Bad debt, you're paying more interest than you're making from having it.
No, there you go. Wisdom.
I'm glad I came up with that because I'm doing a YouTube video on this soon.
So bad debt would be credit cards. Good debt would be a very low interest car payment or a mortgage.
Yeah, I mean, theoretically, a credit card could be a good debt if you could figure out how to make, a 30% return on your money somehow.
I guess that is true.
But like, if you can do that,
hit us up.
Call us because you're gonna have all my monies. Oh man, yeah, right. No, I liked that one. I don't know if I have anything else to say about it.
No,
though.
Number 3.
Let's see. He said, by the time you're 30, you should have at least 1.5 years of your expenses invested. Which, again, I thought I appreciated, and also a unique perspective than you get from most of the sort of like financial world. A lot of people are talking about 3 to 6 months emergency fund, and like that's normally sitting in a savings account. And a lot of times they don't even emphasize a high yield savings account. So you're sitting in a savings account. It's like 0.1%, if that.
Yeah.
It's awful.
And for reference, you're basically losing money if you're not in a high interest savings account because the average inflation is what, like 3% a year, around there. So
yeah, 2 to 3, yeah.
Yeah, so if you're not,
yeah, I mean, most of my high yield savings accounts aren't even like pacing inflation at this point.
Yeah, so kind of losing some money there if you just keep it in a low interest savings account.
Yeah, exactly. So I liked that he said 1.5 years of expenses invested. I think, again, like he applied a good buffer for those times when the market's doing really poorly. And if you say you needed your money last week because last week was horrible, you still had enough of a buffer to take out like probably a full year's worth of full year's worth of expenses. Well, we had like a 12-13% drop last week.
Yeah.
Um, so I think that's good. I've been managing my emergency fund. I have 6 months in a high yield savings, and then the other 6 in an invested fund. I actually just moved that to M1 Finance. I don't know if I told you that.
Mm-mm.
Yeah,
Nice.
I just initiated the transfer the other day. Ally Invest finally. It's finally the last straw for Ally Invest.
It's closed.
Yep.
But
But I liked that.
yeah,
It was good.
yeah, that was good. Number
You have
4.
anything else on that?
Not really. I mean, his point is having 1.5 years of living expenses invested. It really allows you to take more chances in your career and risks. Like maybe you might be able to take that slightly lower paying job because you enjoy it more and that kind of stuff.
Yeah.
Um,
Oh,
or
here's
invest.
something I've been wanting to do on all of these that we haven't done. Where are you at on this?
I have this. Well, currently my living expenses are very low, so I have this right now.
Cool. Me too.
I am 3 for 3 right now before being 30.
All right. I'm 2 for 3 because I still don't have that 750 credit score. So
And you're over 30, so
hey. Enough with this old man stuff. Get out of here. You're gonna be over 30 soon, and I'm just gonna berate you for
dude, I can't wait until I'm 40. I keep saying
it. Okay, so his fourth one that he recommended by the time you're 30 is to create a second source of income in addition to your main job.
Yes. That one I do not have done yet.
Oh, yes.
Do not
Tied it
have
up.
done yet. Nope.
Tied it up. Yeah, so I have I have one other active stream. So I have my consulting work that I'm doing. So that's one other active stream. And then I have a very small passive stream with interest rates and dividends,
Yep.
but it's so small I wouldn't even count it as a second income stream.
Well, actually, this is kind of funny. Because I had number 3 locked up, which was 1.5 years of living expenses invested, I was able to technically turn my previous second source of income into my main source of income because I was doing contracting work for this company, and then
Ah, yeah. Uh-huh.
I enjoyed it so much so that I took a minor pay cut and then was able to join the company. So
Yeah, I mean, to be honest, there's a chance that I'm going to do that in mine as well. So, no, I think that goes to show like the freedom that having some of these things in place allows you.
yeah,
Like you don't. I feel for a long time I got stuck into this place where I kept taking a higher and higher salary in the engineering space, and our living expenses expanded to that. I didn't have anything liquid really outside of my paycheck that came in twice a month or every other week. Um, and I didn't have a second source of income. So every job I took had to at least meet the existing criteria of the job, which means you can only get into basically bigger and bigger jobs, taking bigger and bigger companies. Like those are the opposite of the things that both you and I tend to look for in jobs.
yep,
So I think one of the biggest things I learned out of starting Greenbits actually was that I need to have more cushion because I had an extremely hard time taking the pay cut that I took from GoDaddy to Greenbits. I made it happen, but most of that was by leveraging bad debt to a very significant amount. And having this in place would have enabled me to survive much longer without having to lean on bad debt.
yep,
All right, fifth. He recommends that you aim to save at least 25% of your income each year and invest that amount towards your retirement.
yep. I 100% agree with that. I think the sweet spot is
Where are you at on it?
I think I'm actually about 30%.
Nice.
But that it's kind of gone up and down. Like in the next few months, because I will be moving, my living expenses will likely increase a little bit, so I'll be able to save a little less. But the sweets, like for really the last year, maybe year and a half, I've been able to go between maybe 20 and 30% every month that I've been able to save.
Nice.
And
I'm pulling mine up right now.
this was like a big thing of like when we first started this, like talking about why I sold my car. I was just trying to really,
Yes.
really minimize my lifestyle inflation and then cut out any really unnecessary expenses so that I could save that much, so that I could roll that into having, 1.5 years of living expenses invested.
Yeah. Yeah. Exactly. Yeah. I think I'm working with a friend of ours on this right now. Like I think your very first step in like getting towards this is cash flow. You have to focus on your cash flow first, which is where you and I started out first. It's like let's get budgeting in place so we understand what our cash flow is. Let's get our cash flow to a place where we're cash flow positive, and then you can start leveraging that positive cash flow to do other things. And then at the same time, you're able to like kind of control and adjust your income in various ways.
Yep,
So I've taken the job at GoDaddy enabled me to take a lot of my annual income towards investments. So I'm currently at an annual basis, 54% of my income goes towards investments.
that's beautiful.
It's amazing, but it only lasts until, I leave GoDaddy. If I leave GoDaddy, take a lower paying job, that'll be affected. I'll still be able to keep above 25%. We have our monthly expenses locked down really like within a $300 to $500 a month range now,
Nice.
which is awesome. So we range between like 10.2 and 10.7 a month, which is a lot, but it's what we spend right now. Our rent's a lot higher, and and then our housing payment's going to be higher, and then we still spend too much on dining out, but I can only control so much of that.
Yeah. Plus, dining out is nice every now and again.
Exactly. It's one of those things like I've cut out all the stuff, most of the stuff that like we don't really care about and don't really need, and this is where we landed. But I've gotten to the point where it's like it's within $500, which is pretty accurate. So I know exactly what to take salary wise in order to still have that 25 to 50%. My goal is to get it as high as possible. I actually just had to tweak it down from 55% to 54%
Oh,
because of some consulting contract changes.
oh my.
So I dropped, I don't know, like $2,500 a month in income recently, pre-tax income on consulting. So I had to adjust that. But
That's rough.
I think like knowing this number is really important.
Yep.
Like a lot of people know the number, but it's zero. But I think if you are investing or putting anything into a savings account, even I would classify in this mostly, because it's a form of investment for a lot of people before they realize that investment's not as scary as it can be.
Yep.
I think you have to know this number and you have to know what a target is. For me, the target was always
40%.
40%. I
Yep.
think personally, I think 25 is too low.
Yeah. I was
The way I look at it is
anything
like,
over 30 would be my target at this point.
yeah, like I'm planning on doing the video about this too. But the 80 or the 50/30/20 rule. Are you familiar with that?
Yeah.
So the 50/30/20 rule is a budgeting rule. Basically says take 50% of your income and apply it towards your necessities. So that's rent, mortgage, food, things like that. Take 30% and apply it towards fun things, nice to have things, and then 20% towards investing in your future. And I think that's wrong. For me at least. I think like what's the best way to say this?
You could do 50,
Uh
40, 10.
yeah.
Yeah.
I wouldn't cut out fun entirely. That's a recipe for sadness most of the time.
Yeah.
Some people can do it. Like there's a lot of finance people on YouTube, and Graham falls into this category oftentimes that, in my opinion, are way too far on the frugal side. And it scares people away from financial literacy and financial independence because they look at it and they think, oh my God, I can't ever eat out if I want to be wealthy. I can't ever do X. I can't ever drive a nice car.
Yep.
And that's not the case in my mind, at least. Like you decide how much that percentage is.
Yep.
For me, defaulting across everyone in the world and saying you only invest 20 to 25% of your income, that's a bad starting point. You should start higher and work it down.
I like that.
So maybe that's the way to say it.
That is.
Yeah.
Well, those are the 5 things.
Those are the 5 things. So let's see. We're both 4 for 5.
Yeah, both 4 for 5.
Nice.
Yeah.
So you're working on a second income stream, and I'm working on getting my credit score up.
Yeah.
I got to get that credit score up, man, because we got to get a mortgage soon.
Yeah, we do.
And you're gonna go and buy a new house. I'm gonna buy my new house before you buy a new house. So I'm gonna have to be the one that gets the mortgage on the new house.
The new house.
The new house. Yeah. Yeah. 3 properties this year, right?
Yeah. 10 and we go to Monaco.
Yeah. Oh man, I'm stoked for that. 2021 Monaco.
Monaco Grand Prix. If anybody wants to go, join us.
But you'll have to pay for it yourself.
Yeah, thank you for prefacing that.
This isn't a giveaway or anything.
Yeah, everybody gets to go.
All right, well, that was everything that we had for today. Thank you, everyone, for listening. I know we took a long break. We're back on it. We're going to be trying to do 1 a month this year until we can figure out like a better cadence for it, and hopefully we get the sort of like video and audio stuff figured out, so we can be posting this on YouTube and on everywhere that you listen to podcasts. I think Apple Podcasts is our number 1 source right now, obviously, because like everyone listens to it on there. But Spotify is actually up there, which I was surprised because I haven't done anything to release this on Spotify. So
good on Spotify.
Yeah. So and thank you, Simplecast, for doing whatever you did to put it there.
Yeah.
Yeah. So as always, you can hit us up on Twitter at Trobrock, at Gustin Jabriel. He's got this stupid little upside down face thing that confuses me. And honestly, you look like Stu. You look just like Stu. Every time I see your picture, I'm like, oh, why is Stu on my Twitter feed?
I'm going to start. My Twitter is my least professional online persona by far. So who knows? Maybe
most real.
Yeah, I guess so.
God, I love Twitter. I spend so much time on Twitter.
Yeah, I've been spending more time.
Anyways, let's finish wrapping this show up, and then we can BS about stuff. Yeah. TheFinancialIlliterates.com and YouTube podcast places. Let us know if you have anything that you want us to research or talk about. We have a whole list of topics, but we'd love to hear from you guys. And I think that's it.
Yeah.
So, you have anything you want to say? Because I said all of it.
Fuck no, I'm done.
You forgot. You forgot the whole episode.
The whole fucking episode.
You did. Yeah. I only have to do this at the very end. All right. So before he starts cursing a lot more, we will see you guys next time. Bye.
Bye.